I like life insurance and I hate life insurance, and I'll show you why. Sometimes it's a great benefit, sometimes it's horrible. So if you're driving down the road and home from work tomorrow and you get hit by this Mack truck, I snapped this picture out my window driving down the freeway here, right by our office. If you're hit by a Mack truck, the surviving spouse, and if you're a doctor and you're killed by uh, any truck goes through an intersection, runs a red light, and you're killed, and the surviving spouse decides to file a wrongful death suit against the trucking company or against whoever owns the vehicle, the National Bar Association supposedly hasn't lost a case in 40 years, suing for 15 to 20 times your annual income. So if you're earning $100,000, they could sue for 1.5 to $2 million and win pretty much every time for a wrongful death suit. So the question I pose to a husband and wife is, doctor here has $500,000 of life insurance or $1 million of life insurance, but the human life value of this doctor to replace the paycheck coming into your household would probably require more than that. And so we go through this human life value calculation to figure out how much life insurance would it take to just replace that paycheck. That's the amount of life insurance that you should have if there's a disruption, the breadwinner is gone, the surviving spouse. The goal is for that surviving spouse to continue on without too much financial interruption. Not to say, hey, I got $3 million and now we're loaded. It's to say that $3 million gets invested prudently and generates an income to replace the breadwinner's income so that our family continues to save money for college and pay off debts, etc. So life insurance has either a high life insurance benefit and low cash value, or it has a high cash value and a low death benefit or a low life insurance benefit. All too often, I see we audit people's policies and they're trying to do everything in one place, and it just simply won't work. This is one that we did a few years ago that just is stellar. So this is a statement from September 2012. Prudential, which is a great insurance company, and this is all legal, they said, you've averaged 14.2% for this period from January to September. We did 14.2% in a life insurance policy. That's amazing. The client sent it to me and said, hey, I did 14%, and since I bought the policy a long time ago, I've done 4.3. And I said, awesome, send me the rest of the pages. Let's look at it. So this is another page from the exact same report in 2012. Here's the interest earnings that this client achieved, which is $1,113, which is 14% growth, 14% return on investment over that time period. But let's look at the cost of insurance and the miscellaneous admin charges that all kind of add up. We add those together, and it cost $1,322 to have that life insurance policy as a cost. So we'd have to do more than 14% just to break even and cover the costs of this Prudential policy. Do you think that that's something that you want to own? Maybe not. Let me show you maybe one more here that I have. I'll blaze through it really quick. So this actual doctor paid in $135,000 since March of 2009. This doctor had given $135,000 since March of 2009 to an insurance company with the goal to create cash value in a Roth alternative to subsidize his retirement income. So it's great. Hey, put money with a life insurance company, it grows tax-free, and you can pull the money out tax-free. From a tax standpoint, it functions just like a Roth. The problem is the way this policy was structured was right off the shelf. No advanced planning around it, high commissions. It sounded really good. Everything looked good from an insurance standpoint. But this thing is a dog, and let me tell you why. So when we audited the policy last year, the client was 60. The plan was to continue to fund it, and then stop all premiums. So the total in would have been $227,000 by the time he retires. Now, let's look at the net cash value. I paid in $135,000 several years ago, 2009 is when I started it. I have $15,358 of cash value. So I gave him $135,000, I have $15,000. Now if I keep doing this plan, then I'll have almost $70,000 by the time I stop funding it. And here's what makes matters worse. So that's pretty bad to give $227,000 over a decade and get over 12, 13 years and get a fraction of that in your cash value, a fraction. So I like to see these, if you do life insurance, I like to see a break-even date of 7 years. So if you start the plan, you have more cash value than you paid the insurance company by year 7 to 8. And from that point forward, you should see a growth of about 5% tax-free, which is, in a lot of our tax brackets, it's close to 7 or 8% in a taxable environment with no downside risk, and it goes up and performs better when interest rates go up. So it's actually a really positive asset to hold. But here's what really chapped this doctor's hide is, well, yeah, but I have a $1.5 million life insurance benefit today. $1.5 million life insurance benefit. I'm willing to kind of pay the premiums and eventually this will be good. But this illustration we ordered together by calling the insurance company on the phone at the same time, and I told the insurance company, I want you to show me this policy with no money coming out. Just let it ride without any Roth alternative distributions, and let's keep the death benefit as high as we can. So in 2 years from now, they would drop the death benefit from 1.5 to 300,000. Once he stops funding, they would drop it to 150,000. Paid in 227, if he dies, he gets 150,000 back. If he wants the cash and walk away from the 150, he can take 70,000 back. Horrific, but this is real life. This actually happens.